A small financial mistake rarely feels dangerous in the moment because the immediate consequences often appear manageable, temporary, and isolated from the rest of life. Someone misses a credit card payment, delays replacing worn tires, ignores a small debt balance, spends slightly beyond budget for a few months, or postpones building emergency savings because more urgent priorities keep appearing. Individually, these decisions often look harmless. The problem is that modern financial systems are designed in ways that quietly amplify instability over time, which means small financial errors frequently trigger secondary and tertiary consequences that become much larger than the original mistake itself. Imagine two people facing the exact same unexpected expense of $500. One has savings, low debt, stable cash flow, and access to low-interest credit. The other has minimal reserves, inconsistent income, and existing financial pressure. The numerical problem is identical, yet the economic impact becomes completely different because financial systems reward stability while punishing fragility. The first person absorbs the expense and continues normally. The second may rely on high-interest debt, miss future payments, accumulate fees, damage credit history, increase stress levels, and reduce future financial flexibility. The original expense disappears quickly, but the secondary consequences continue growing long afterward. This is one reason financial mistakes become so expensive. Most people focus only on direct costs while ignoring compounding side effects. A missed payment is not merely a late fee. It can also increase interest rates, reduce credit access, weaken borrowing terms, increase insurance costs, create overdraft penalties, and force future decisions into narrower and more expensive options. Financial systems are deeply interconnected, which means instability in one area often spreads quietly into multiple other areas over time. The mathematics of compounding works in both positive and negative directions. People usually associate compounding with investing because long-term returns gradually accelerate wealth growth. But compounding also applies to debt, penalties, stress, lost opportunity, and financial fragility. A small amount of instability today can create larger instability tomorrow because each problem reduces the ability to absorb future disruptions. Once financial margin disappears, ordinary setbacks begin carrying disproportionate consequences. Consider the psychology of financial pressure. When reserves are low, decision-making becomes increasingly short-term because immediate survival naturally dominates long-term optimization. Someone under financial stress may prioritize short-term relief even when it increases long-term cost. This is not irrational behavior. It is often a rational response to unstable conditions. A person struggling with cash flow might delay preventative health care, postpone maintenance, avoid investing, or use expensive short-term borrowing simply because immediate liquidity matters more than future efficiency. Unfortunately, these choices often create larger expenses later. Car maintenance provides a simple example. Replacing worn brakes early may cost a few $100s. Delaying repairs can eventually damage rotors, reduce safety, increase accident risk, or create complete transportation failure. The later repair becomes dramatically more expensive than the original preventative action. Financial mistakes often behave similarly because systems deteriorate gradually before failing suddenly. The same pattern appears in personal debt. Small balances initially feel manageable because minimum payments remain relatively low, but compound interest quietly changes the structure of the problem over time. High-interest consumer debt grows faster than many people intuitively expect because interest charges begin generating their own interest charges. Eventually, a growing percentage of income gets redirected towards servicing old financial decisions instead of building future stability. The debt itself starts reducing optionality. Optionality is one of the most overlooked concepts in finance. Financial stability is valuable, not only because it provides comfort, but because it creates flexibility. People with reserves can wait for better opportunities, negotiate more effectively, tolerate temporary setbacks, and avoid desperate decisions. Financial fragility removes these advantages. Once optionality shrinks, people become more vulnerable to expensive mistakes because they have fewer alternatives available when problems appear. Modern economic systems intensify this dynamic because many industries price risk aggressively. Stable individuals with strong financial histories often receive lower interest rates, better insurance pricing, favorable financing, rewards programs, and easier access to opportunity. Financially unstable individuals frequently encounter the opposite environment, including penalties, higher borrowing costs, security deposits, overdraft charges, and restrictive lending conditions. Existing instability therefore attracts additional friction. This creates an important asymmetry. Financial stability compounds efficiency, while financial instability compounds cost. Two individuals with similar incomes can experience dramatically different financial trajectories depending on how much friction exists inside their systems. One person spends energy building assets, while the other spends energy recovering from recurring disruptions. Housing illustrates this clearly. Someone with strong credit and savings may qualify for lower housing costs, favorable financing, and stable living conditions. Someone with weaker financial positioning may pay higher rent, larger deposits, additional fees, or more expensive short-term arrangements. Over many years, these differences compound substantially. Small financial weaknesses therefore produce long-term structural costs that are often invisible in the beginning. Time also becomes expensive under financial stress. People operating near financial limits frequently spend enormous amounts of time solving problems caused by instability itself. They may manage debt negotiations, recover from overdraft issues, repair damaged credit, handle transportation failures, navigate administrative complexity, or work additional hours simply to restore stability. Wealthier individuals often use money to purchase convenience, speed, delegation, and reduce friction. Financially stressed individuals frequently experience the opposite condition, where scarcity consumes time continuously. Behavioral economics helps explain why these cycles become difficult to escape. Human decision-making changes under chronic stress because uncertainty narrows attention toward immediate threats. Long-term planning becomes cognitively harder when short-term survival repeatedly interrupts focus. This does not mean people suddenly become irresponsible. It means unstable environments alter behavior naturally. Financial systems then magnify the consequences of those altered decisions. Credit scores demonstrate how modern systems remember instability. One late payment may appear small emotionally, but algorithmic systems interpret patterns statistically. Reduced credit quality can quietly increase borrowing costs across multiple areas of life for years afterward. The original mistake may disappear quickly, but the secondary consequences persist much longer afterward. Financial systems therefore extend the lifespan of small mistakes far beyond the initial event itself. Importantly, not every financial mistake becomes catastrophic. Context matters enormously. Small mistakes are far less dangerous when strong buffers exist because reserves absorb shocks before they spread into other areas. This is why emergency savings and financial margin matter so much. They reduce the probability that isolated problems evolve into systemic instability. Many people assume wealth building depends mostly on maximizing income, but reducing fragility often equally important. Preventing negative compounding sometimes matter more than chasing positive returns. A person consistently avoiding major financial setbacks may progress more steadily than someone pursuing aggressive gains while repeatedly encountering expensive disruptions. Stability itself becomes a form of financial leverage. There's also a cultural tendency to underestimate slow-moving consequences because human psychology responds more strongly to immediate visible threats than gradual accumulation. Compound interest, inflation, debt growth, subscription spending, fees, and opportunity costs often remain psychologically invisible for long periods before suddenly becoming obvious. By the time the full cost appears, reversing momentum becomes much harder. The broader economic environment amplifies this further because modern systems increasingly reward predictability and punish volatility. Employers, lenders, insurers, landlords, and financial institutions all evaluate risk continuously. Individuals with stable financial patterns often receive smoother treatment, while instability creates additional scrutiny and cost. Small financial mistakes therefore interact with larger systems that magnify differences over time. This does not mean perfection is necessary. Every person makes financial mistakes. The more important lesson is understanding how fragility changes the consequences of mistakes. Small errors become dangerous primarily when financial systems lack buffers, flexibility, and recovery capacity. Stability reduces amplification. Fragility increases it. Ultimately, the hidden danger of small financial mistakes is not the mistake itself, but the chain reaction that follows afterward. Modern financial systems are highly interconnected, deeply compounding, and heavily influenced by stability. Once friction begins spreading across multiple areas of life, recovery becomes increasingly expensive in both money and time. That is why small financial mistakes often become so expensive, not because the original decision was massive, but because instability quietly multiplies consequences long after the initial moment has passed.